So how do you actually cut through all the noise in today's financial markets? I mean, we all face that constant flood of data.
Yeah, it's relentless.
But how do you spot the really important signals? The ones that tell you what's actually driving things?
It's a huge challenge. You want to be informed, properly informed, but without, drowning in information.
Absolutely. And that's really our mission today. We're doing an in-depth look, a deep dive into a recent weekly market brief. It's dated June 2025.
Right.
And this isn't just about reading a report out loud. It's about pulling out the most crucial bits, understanding what's really moving the needle.
Giving you that shortcut, hopefully.
Exactly. A shortcut to feeling, genuinely well-informed about the whole global economic picture.
And we're using this single source. It's pretty comprehensive, this market brief, packed with data analysis, all as of June 27, 2025.
To find maybe some surprising facts, some practical takeaways.
That's the plan. Things that might shape how you think about the markets going forward.
Okay, let's unpack this then. The thought of the week in this brief, it kind of jumps out immediately.
Mm-hmm.
It makes a pretty strong case that if market volatility picks up, so in the second half of 2025.
Which, is always a possibility.
Right. Then income strategies, especially those focused on dividends, they might actually prove surprisingly resilient. That's quite a claim, isn't it?
It is, yeah. And what's fascinating is the logic behind it. The brief talks about this sort of rule of thumb.
Okay.
That dividend growth, it typically only falls by about half as much as profits do when earnings take a hit.
Interesting. So it suggests companies really, really try to avoid cutting those payouts.
Yeah.
To avoid disappointing shareholders.
Exactly. It seems like it's almost a strategic priority for many of them.
And it gets even more interesting because the brief gives two specific reasons why dividends might be even more resilient right now in this specific environment.
Right, beyond the general rule.
First, it points out that payout ratios, that's the share of earnings, paid out as dividends, basically. They've stayed really quite low ever since the pandemic.
Which gives them flexibility.
A lot of flexibility, exactly. So if earnings slow down, companies have room, they have a cushion to keep paying dividends without getting into trouble.
Precisely. They're not stretched thin on that front. And the second reason, it's about cash. Those ample cash buffers lots of companies are sitting on. The brief notes that, trade uncertainty and maybe other factors are already causing companies to pull back a bit on capital expenditure CapEx.
So less spending on big projects.
Right. Less spending there. And since corporate balance sheets are generally looking pretty healthy, most companies should have enough cash, a good buffer, to handle slower profit growth if the economy does cool off a bit more.
Okay, so connecting this back to you, the listener, why is this actually important for you?
Well, it's not just theory, is it?
No.
Yeah.
It highlights a potential strategy, maybe, for navigating market ups and downs, a way to think about investments.
And it gives you a deeper insight into how companies are doing financially, what they prioritize, especially when things get a bit uncertain economically.
Right. It's about reading the corporate mindset almost.
Kind of, yeah.
Okay, so moving from that sort of longer-term strategic thought to the very near future, what key economic bits should we be watching out for in the coming week?
Yeah, the immediate horizon.
The source gives us a rundown starting Monday, June 30th. It's like getting a sneak peek at next week's financial headlines, isn't it?
It really is. And these are the numbers that can genuinely move markets, signal shifts. So Monday, we've got China's NBS general PMI. The prior reading was 50.4.
Just above that 50 mark, separating growth from contraction.
Exactly. So crucial for checking the pulse of their economy, manufacturing, and services combined. Also on Monday, Japan's industrial production, month on month, it was down 1.1% previously.
So looking for a rebound there or further weakness.
We'll see. Then Tuesday looks like a really packed day for data releases. We get another China PMI, the cakes and manufacturing one. Prior was 48.3, so that was in contraction territory.
Right.
Then in Europe, the big one is the headline HICP inflation figure, year on year. Prior was 1.9%. Critical to see if inflation is staying low there. The UK has nationwide house prices month on month. Last reading was up 0.5%. Gives us a sense of their housing market.
And the U.S.
Two really key U.S. figures on Tuesday. First, the ISM manufacturing PMI prior was 48.5, so also below 50.
Still struggling a bit in manufacturing then.
Seems like it. And also U.S. JOLTS job opening.
Yeah.
Prior was 7.39 million.
Yeah.
Both of these are super important for gauging manufacturing health and the labor market tightness.
Yeah, those JOLTS numbers get a lot of attention. Signals that could definitely sway how people think about the Fed.
Absolutely.
Wow. Okay, Tuesday sounds critical. What about the rest of the week?
Well, Wednesday brings the Eurozone unemployment rate. It was 6.2% previously. Watching if that ticks up or down tells us about their labor market strength. And then Thursday rounds things off. We get China's cakes and services PMI. Prior was 51.1, so that was expanding. Important to see if services are holding up.
And then more big U.S. data.
Yes, the really big U.S. labor market report. Non-farm payrolls prior was 139,000, which was maybe a bit softer than expected.
Mm-hmm.
The U.S. unemployment rate itself, prior 4.2%. And the U.S. ISM non-manufacturing PMI, so the services side, which was just under 50 last time, at 49.9.
So that services PMI barely dipping into contraction. Lots to watch there.
Definitely. Those U.S. jobs and services numbers are always huge market movers, signs of momentum or maybe further slowing.
So yeah, keeping these events on your radar is just crucial. They're powerful signals for economic health, for market sentiment.
Knowing what's coming helps you make sense of the headlines when they hit.
Understand why markets might be jumping around. It's about being prepared, not just reactive.
Exactly. Staying ahead of the curve a little bit.
Okay, so we've looked at a potential strategy, dividends, and we've looked at the week ahead. But hang on, what actually happened in the markets last week?
Good point. Let's ground ourselves in the recent reality.
Let's look at the market performance, see how these themes might already be playing out. This is as of June 27, 2025. Paints a picture of where the money has been going, right?
Absolutely. And looking at equities, stocks, it was actually a pretty strong week overall.
Oh, really?
Yeah, the MSCI AC World Index, it's a broad global measure, was up 2.9% just in that 1 week.
Wow.
It's sitting at 6.9% up for the year to date, and a solid 13.5% higher than a year ago. So suggests some broad optimism globally.
Okay, and regionally. Any standouts?
Well, in the past week, the S&P 500 in the U.S. led the charge, up 3.5%. Germany's DAX was also strong, up 2.9%. And MSCI China gained 2.7%.
Trying to bouncing back a bit, maybe.
Seems like it. And if you look year to date, the picture gets even more interesting. Some really big numbers, especially in Europe and China, actually.
Like what?
Spain's IBX is up a huge 23.2% year to date. The DAX up 20.7%. Italy's FTSE MIB 20.2%. And MSCI China is up 19.0% for the year.
Okay, that's some serious momentum in those markets then. Quite different from the, say, the U.S. GDP figures we'll get to.
Very different. It highlights that divergence.
So a good week for global stocks generally. What about drilling down into sectors? Where was the action?
Right. Sectors tell a story, too. Last week, communication services jumped 5.2%. Technology up 4.5%.
Ah, so a return to growth stocks.
Looks like it. A real appetite for growth. Consumer discretionary was also up nicely, 3.6%. Industrials, 3.1%. Financials, 3.0%.
Okay. Any losers?
Interestingly, yeah, energy was down 2.8%. That probably reflects the big drop in oil prices we'll talk about. And consumer staples dipped slightly, down 0.3%.
So maybe investors rotating out of defensive names.
Could be. Now, year to date, the leaders are industrials and financials, both up a healthy 12.8%. Utilities also strong, up 11.4%. But healthcare is actually down 2.0% year to date. And consumer discretionary is also down 1.0% for the year, despite that strong recent week.
Huh. So the picture isn't totally uniform, is it?
Not at all. It shows the shifts happening under the surface. And one more point. Growth stocks definitely outperformed value stocks last week. 3.7% gain for growth versus 2.0% for value.
Reinforcing that tech-led, growthy feel to the market recently.
Exactly.
Okay, so stocks generally positive, but with these interesting sector stories. What was happening in the bond market? Fixed income.
Well, generally, bond spreads were tightening.
Which is usually seen as a good sign, right? Less perceived risk.
Yeah, exactly. It suggests the market feels a bit more confident about credit quality, about lending. For instance, global investment grade spreads came in 1 basis point to 90 BPS, that's 0.90%.
Tiny move, but in the right direction.
Right. Emerging market sovereign dollar debt spreads, the EMBAG index tightened 5 basis points to 293, global high yield tightened 7 basis points to 335, all pointing towards maybe a bit more risk appetite or confidence.
And government bond yields. the benchmark 10 years?
There we saw some divergence. The 10-year U.S. Treasury yield dropped quite notably, down 10 basis points to 4.29%.
Okay, so lower borrowing costs there.
And the UK 10-year yield also dipped, down 3 basis points to 4.51%, maybe suggesting some easing of inflation or rate hike fears in the US and UK?
Possibly, but not everywhere.
Not everywhere, no. Germany's 10-year yield actually went up 8 basis points to 2.60%, and Japan's 10-year yield rose 5 basis points to 1.44%.
So different stories playing out in different major bond markets.
Yeah.
Maybe different growth or inflation outlooks driving that.
That would be the logical conclusion, yeah.
Okay, and commodities. You mentioned oil earlier. I know Brent crude has been making headlines.
It certainly has. A really significant drop. Brent was trading around $68 a barrel. That's down a hefty 12.0% just last week.
12%, wow.
Yeah, and it's down 9.4% year to date and down over 21% compared to a year ago.
That screams concerns about global demand, doesn't it?
It really does. That's a major signal. Gold, though, is a different story. It dipped a bit last week, down 2.8% to $373 an ounce.
Okay.
But it's still way up for the year, 24.7% year to date, and a massive 40.5% higher than a year ago.
Still acting as that safe haven, that store of value amidst all the uncertainty.
It seems so, holding on to most of its strong gains.
And quickly, currencies. Any key levels from the source?
Yeah, the brief mentioned a few key rates. The dollar was at 1.17 per euro. The pound was at $1.37. The euro was buying 0.85 pounds. And the yen, 170 yen per euro and 145 yen per dollar.
Okay. Just snapshots, but they reflect those shifting economic tides and rate expectations.
Exactly.
And lastly, volatility. The VIX, often called the fear index. What did that do?
It actually dropped quite a bit last week, down to 16 from 21 the week before.
So less fear in the market, calmer sentiment.
Suggests that, yes, less immediate worry among investors. But it's worth noting, it is still higher than it was a year ago. Back then, it was around 12.
Ah, okay. So calmer than the previous week, but maybe still a bit more underlying nervousness than a year prior.
That seems like a fair reading, yeah.
These numbers, they really do paint a vivid picture, don't they? You see investor confidence ebb and flow where capital is moving globally.
Understanding these trends really helps you grasp the market's narrative right now. Makes the headlines make more sense.
Okay, now let's try and zoom out even further. Connect these market moves we just talked about to the bigger economic picture, and also how expensive are markets looking? Valuations, this is where we try to tie it all together.
Right, the macro backdrop for all that market action. So, looking at the latest GDP growth figures reported in the brief.
Yeah.
The Eurozone came in at 2.5% growth, the UK at 2.9%, China pretty strong at 4.9%.
Okay, solid numbers there.
But here's the striking part. The US GDP figure was actually negative, minus 0.5%. And Japan, also negative, minus 0.2%.
Wow, okay, so economic contraction in two of the world's largest economies, that definitely stands out.
It really does, a key point to consider. And then looking at inflation, the CPI figures.
How are they looking?
Well, the Eurozone is at 1.9%, so just under the ECB's target. The UK is higher at 3.4%, the US at 2.4%, Japan at 3.5%.
So mostly still above those central bank comfort levels, suggesting inflation pressures haven't completely gone away in many places.
Exactly. Persistent pressures. But again, China is the outlier. Their CPI is negative 0.1%.
Deflation.
Suggests deflationary pressures, yeah. Which brings its own set of economic worries. So a really mixed global picture on growth and inflation.
That is quite a mixed bag of signals, isn't it? Strong growth in some areas, contraction in others, inflation still sticky in places, deflation in China. So how does all this feed into market valuation?
That's a crucial link.
I mean, how do these health checks, especially those negative GDP numbers for the U.S. and Japan, affect what investors are willing to pay for future earnings?
It's the million-dollar question, really. The brief gives us some forward price-to-earnings ratios, which give a sense of valuation.
Oh, okay.
The MSCI World Index is trading at 19.8 times forward earnings. The S&P 500 is at 22.2.
Whoa, 22.2 for the S&P. That's the highest listed, right?
Yeah.
Seems quite pricey, especially given that negative U.S. GDP number.
It does seem elevated, yeah. Perhaps reflecting the dominance of those big tech growth stocks we saw performing well despite the broader economy.
Maybe. And elsewhere.
In contrast, MSCI Europe is valued at 14.7 times forward earnings. The UK's FTSE 100 is at 12.4, and MSCI Emerging Markets at 12.9.
So much lower valuations outside the U.S. generally.
Generally, yes. These numbers give you a snapshot of where valuations stand, and they're definitely influenced by that complex mix of macro data we just talked about. It suggests investors are currently paying quite a premium for U.S. earnings compared to other parts of the world.
What a journey we've taken. Seriously. Yeah. From digging into why dividends might be resilient.
That thought of the week.
Right, to mapping out the key economic events on the horizon next week.
The data deluge on Tuesday.
Exactly. Then walking through last week's actual market performance, stocks, bonds, commodities.
Seeing where the money flowed.
And finally, connecting our back to that bigger, kind of messy macro picture and valuations. You've just absorbed a ton of really crucial context.
Hopefully it helps navigate the days and weeks ahead.
Yeah. I mean, if we tie this all together, you should now have a much more nuanced view of what's shaping global markets than you'd ever get from just glancing at a headline.
You're not just seeing the numbers move, you're starting to understand the why, the potential implications.
Right. And maybe here's a final thought, something to chew on. We talked about the market focusing on dividend resilience if volatility picks up. And we combine that with this really mixed bag of macro data, negative GDP in the U.S. and Japan, deflation fears in China, sticky inflation elsewhere.
Yeah, confusing picture.
So what does this tell us about how predictable traditional economic numbers are right now, compared to maybe more adaptive corporate strategies, like maintaining dividends? Which lens is going to be more crucial for you to watch in the coming months? The big macro picture or the specific things companies are doing on the ground?
That's a great question to ponder. Where should the focus really be?